you didn't have money to make your 30-year fixed mortgage payment, you're going to ruin your credit and go into default, right? Well, the reverse is true with the all-in-one.
We are opportunistic investors here. When we see an accumulation of equity in a property or cash in an account, we want to get that moving. So with this all-in-one loan, again, which is like a first lien HELOC, I would imagine that when we get plenty of room to borrow more in there, and there's been plenty of pay down, we might want to draw against it again for another purchase and let this thing be flexible like an accordion back and forth as you're drawing the balance down and you're extending it out again. So really the way I see the flexibility with the all-in-one loan is that you don't have to go through another mortgage loan origination each time you want to buy a property. You can just draw against this account.
And we're still just scratching the surface in what this thing does. Exactly right. And I've said this twice now, you've become your own bank.
Yeah.
Okay. If you pay it down over a short period of time, let's say that you had $500,000 and you were able to reduce that down to $300,000. Okay. There's a $200,000 spread there that at your discretion, you don't have to pre-qualify and pay closing costs again. You don't have to ask permission or get it approved for some reason. Those are your funds, your equity, your dollars to do what you want, when you want, how you want. The other thing too is probably a good place to point this out, safety net, okay?
Right.
As long as there is a spread between what you owe and the credit limit, right, whatever that is, if something were to happen that was unfortunate, some unfortunate set of circumstance befell the family, whatever, and no income was coming into the household, zero. Okay. What would happen if we talked about this earlier, if you didn't have money to make your 30-year fixed mortgage payment, you're going to ruin your credit and go into default, right? Well, the reverse is true with the all-in-one. If there is a spread between the balance and the limit and you needed to not make any deposits, the only thing that's going to happen in that case is interest is going to accrue on top of that balance. The only time a payment deposit is mandated with the all-in-one is when the balance is about to exceed the limit. That's the only time. Now, I'm not saying that that's the way people are going to use it, but that's the reality of it. So what if this, let's take this down the rabbit hole for a second. If you couldn't make a deposit, you're not going to go into default, right? You're simply going to add some interest on top of the existing balance. But what if you needed to draw from it for living expenses for a couple of months?
Yeah.
What if you needed, $5,000 a month for 3 months until you got back on your feet? Whatever it is, you have access to do that. There's your safety net. You just simply draw from it. As long as there's a spread between the balance and the limit, those are your funds to do with what you choose.
Gosh, so if one takes out, a HELOC, whether that's in an all-in-one loan form or not, something that I've advocated with my listeners for years is that, now you do have this line that you can draw against. To your point, Shaylee, it's effectively another layer of insurance for that borrower or investor. So if you're interested in keeping down your insurance premium, you can get a HELOC or an all-in-one loan, increase your insurance deductible, which can lower your insurance premium and increase your cash flow.
Good point. I hadn't even thought about that before. That is a new one on me. That is actually brilliant. Yes.
Now, we had a listener quite a while ago, Mark from Granite Bay, California, write in. Mark's a great longtime listener. When he found our show, he wanted to go back and re-listen to all the old episodes, and he listens to several episodes multiple times. And Mark wrote in because he heard you on the show quite a while ago. And Mark says, I've been using the all-in-one loan's amazing mortgage balance deduction, but as a GRE listener, I know I can't be lured in by that alone. I also need to utilize its leverage. I just use my all-in-one loan, Mark continues to say, probably like a lot of others, to buy a duplex for Mid-South home buyers in all cash and then refinance that loan into a Fannie Freddie 30-year from my all-in-one loan simulations. And Shaylee has a all-in-one loan simulation on her website that she'll tell you about. But to finish Mark's question, Mark says, I have gathered in these simulations that as long as properties are cash flowing, the best use of the all-in-one seems to be to keep repeating what we did on our first duplex purchase, use the all-in-one loan to buy properties in all cash, and then later refi it into better debt or leverage, and then continue to repeat the process. Is that a valid way to use it? That's Mark's question.
Absolutely, Mark. Well done, sir. And there's a few points here that I want to take a minute and peel back, Keith. So one of the first things that I would say that's really great about that philosophy or that strategy is going to be that On a cash out refinance of the property that was paid cash using the all-in-one, we get to use the appraised value. So under the circumstances, if you paid $100,000 for it and perhaps it valued at 110, 105, 120, whatever it is, then we as the lender are going to refinance on a cash out refinance using that higher appraised value. So you'll have a little bit more leverage there and potentially get more in that loan to value when you're comparing what you're getting back versus what you put in. We can go through some simulations there in a second. So that would be the first thing that I would say. The other thing, obviously, is that when you're dealing with a turnkey or a seller or an agent, whatever, everybody knows that when you can come to the table with cash,
Yeah.
right, you become the more desirable buyer. Okay, so there's that obvious piece. And then in terms of that strategy and that simulation, so please, yes, that is absolutely the first thing that I'm going to do with anybody that calls in is I'm going to get on the phone with them, a Teams call, and we're going to do the simulator together. But I encourage everybody to get in there and play around with it. If you're not quite sure what data points it's asking for, let us know or we'll do one together. But that simulator is going to allow you to compare the all-in-one to either an existing mortgage on a primary rental property or a new traditional mortgage. Let's say you're thinking about buying an investment property with a 30-year fixed and you want to compare that to the all-in-one, or maybe you want to refinance one of your existing properties. So you can compare it to existing versus new. And then within that simulation, it will allow you to forecast additional spending that will allow you to say, I want to take out $50,000 in month 22. Right? And it'll reformulate where the simulation of saved interest, payoff time, all of those things will be available to you within that simulator. It's very slick.
And now that you, the investor, have the ability to pay all cash, not only can you close faster, but a lot of times sellers are willing to give you a discount since you can close faster and pay all cash. And then it's up to you down the road to go ahead and refinance that into a conventional product or however else you want to do it.
Head to our website, ridgelendinggroup.com. You can email us info@ridgelendinggroup.com. And obviously, we're always a phone call away at 855-74-RIDGE.
And again, you can find that all-in-one loan simulator where you can plug in some real numbers and see how it can benefit you. A friendly representative from Ridge can help you go ahead and do that there. You can watch this one next.